St. Louis, and welcome once again to What Retirement Means to You with Jerry Means. He is the founder of the Means Financial Group right here in St. Louis. I'm your host, Spike Spangle. Jerry, it is great to see you. Look at that smile. You get so excited about retirement planning. It's good to see you.
How are you doing today, Spike?
Very good, very good. Unfortunately, we have a lot of things to report for retirees that you're going to talk about. Again, you're the founder of the Means Financial Group. He helps folks with their retirement planning strategies, looking at everything from investments, long-term care, medical care, legacy planning, tax strategies, everything that goes into this ball of wax. But today we're going to be talking about inflation and how it is impacting today's retirees. First thing I'll say to you, from a report from CNBC, 71% of retirement age investors are worried that inflation is going to push out their retirement dates. How do you feel about that? Are you seeing that happening? Are people calling and worried about if they can still retire?
I am, and we're basically having that conversation with everyone that comes into the office. I mean, we see these statistics, 7 out of 10. I don't know who they're polling, but everyone that I'm talking to is wanting to know about inflation and how's it going to affect their retirement. What do I think is going to happen? So it's a daily conversation that we're having.
Yeah, so you're getting like 12 out of 10 people saying,
Correct.
I'm worried about inflation right now. So one of the things I think that you do for your clients is kind of give them the peace of mind that you've already taken these kinds of things into account. Inflation, market downturns. We'll talk about that as well. How is it, though, that you can have certainty in helping people retire when there are uncertain factors like inflation?
Well, I think it comes to having the right plan and really addressing those head on. You know, your plan should account for inflation.
Yeah.
And I used to run numbers. We would look at 3 to 4% a year increase because I always liked, even though the statistics were lower than that, I like to kind of overplan for it.
Okay, so you would overshoot inflation.
I would overshoot inflation and say, okay, let's test your portfolio. Hypothetically, what if we had 4% inflation every year during your retirement? What is that going to look like? And if we had to increase your income off of your plan. But now we're actually looking at even higher numbers, you know, or just basically bumping up the income ahead of time.
Almost triple, if you will. I mean, at 8.5% this year, it was almost 6% last year. Now, there are some things for those who are already retired that were positive. Cost of living adjustment on their Social Security was actually almost 6% as well. But one of my concerns about that is that happens in arrears. Meaning you spent the whole last year having to pay more for your goods and services, and then you got a raise on it later.
Yeah.
The same thing's going to happen this year, and costs of goods and services are up 8.5%. And there will be a cost of living adjustment, but later. So what can you do to help people fight it right now?
Yeah, well, first of all, you're right about the cost of living increase on like Social Security.
Yeah.
But any retiree that will tell you that as soon as they get that increase, their Medicare premiums go up about the same amount. So it ends up being kind of a wash. And, you know, Social Security is just not going to keep up with the inflation. So Social Security has its problems on its own, but now you add in the increasing inflation and Social Security not keeping up with it. We have to find other ways to fill that gap.
Okay. All right. Now, when you say other ways, are you talking about taking more risk in the market? Because where are our markets today? Our investment markets, that is.
Well, part of the problem with the markets is the government's trying to slow down inflation, right? So they're raising interest rates, which the interest rates aren't high enough to help those on a fixed income. Inflation affects retirees more than anyone else, right? I mean, we think the average worker that's still in the workforce that goes into the grocery store, their grocery bill might be going up by, you know, $30, $40 each time they go in, and they feel that. But they can work overtime. There's different things that they can do. They can budget a little bit differently. But a retiree that's on a fixed income, you know, they're having to pull that out of their nest egg and do that in a down market. You know, that really adds insult to injury.
Right.
But the government trying to slow down that inflation is affecting the stock market. So interest rates are low, stock market's volatile. So where do you get fixed income? So you have to be creative and you have to look at alternative strategies. There's things like fixed indexed annuities where you get a portion of the upside of the market, but none of the downside risk. Now, these are longer term contracts. They're designed for income, right? And that's what we're talking about. But, there's, just to give you a hypothetical, let's say that the index annuity has an 8.5% cap. That means they base the interest rate on the S&P 500 index. If the index goes up 10%, you're only going to get 8.5. That's still 85% of the market upside, right? It's really not that bad. But if the market goes down, you're going to get a zero. You don't lose anything, but you lock in your principal and all of your previous earnings. So it can be a great alternative to bonds, to sitting in cash, right? Because a lot of people are sitting in cash and bonds thinking they're safe, but bonds year to date are down about 10% on average. And treasuries are down even more than that.
Right.
So what used to be safe isn't safe anymore.
I wanted to ask you about that. So the stock market is down, and that's usually what happens. People will jump over to safety. We know what cash or money markets are earning. Essentially nothing right now. So if you have moved to cash because you're scared of volatility, you're losing at least 8% this year alone to inflation. So then the other place we run for cover is bonds. Why is the bond market doing so poorly as well?
Well, part of that is when interest rates go up, bond values tend to fall. So again, just giving you an example, if you have a $1,000 bond paying 3% interest, and it's a 2-year bond, and within those 2 years, you need to cash it out, but new bonds are paying 4%. Who wants your 3% bond? So you have to sell it at a discount. Now, if interest rates are falling like they did over the last 20 years, bond prices go up. So we're kind of at the end, or we definitely are at the end of a bond bull market, right? Everyone thinks about a bull market as being the stock market, but we've been in a bull bond market. Interest rates were falling, bond values were going up. It was a great safe haven.
So it almost seems like the bond bull market was even longer then, right? Because, I mean, the interest rates have been falling and falling and falling
about
for
18 years.
I was about to say a couple of decades, it seems
about
like.
18 years.
So we're at the end, possibly, of the stock market bull run, 13 and a half years of going up. And it definitely seems like the end of the bond bull market. The nowhere to go, nowhere to hide, possibly looking at things like annuities. Do you mind if we talk a little bit about that when we come back from break?
Yeah, I would love to do that.
One of the things I know that you do, though, before we go out to commercial, before we lose anybody, before everybody gets up and goes for a snack or go gets a soda pop at the fridge, you've got your on-track retirement review that you will do complimentary for those who call into the program. What kinds of things exactly will you look at for folks?
So this is for pre-retirees or people that are already retired. If you're within 10 years of retirement and you're starting to think about these things, we can sit down and we can stress test your portfolio. We can put in inflation what ifs. We can put in market volatility, and we can see if you're, what you're paying in fees. But it's basically a full-blown on-track review. We want to make sure that you're on track to retire, or if you're already retired, we want to make sure that you stay on track. So it's, again, complimentary to the first 10 callers.
Folks, if you want to make sure that your retirement is going to stay on track, whether there is inflation going on, the stock market is down, or the bond market is down, call Jerry Means right here, 844-878-1231. The first 10 callers will get your on-track retirement review absolutely complimentary. If you're not one of the first 10, we'll put you on the call list, but it's going to take a little bit longer to get into the office, but we'll get to everyone. Call right now, 844-878-1293. We'll be right back after this.
How confident are you in your current financial plan? Do you know with certainty how the recent market volatility will affect your future hopes and dreams? How much are you paying in taxes? And how much are you losing to unnecessary high fees? You didn't work to save this money so that you could spend your time worried in retirement. Now is the time to take charge of your finances so you can feel confident about your future. Call in during the next 30 minutes of today's show only to set up an absolutely complimentary, no obligation, full-blown financial review that will result in your own customized written plan that we're giving away complimentary to the first 10 people who respond. We'll start with a full-blown analysis of what you already have by running a report to untangle how much you are currently paying in fees, how you're allocated for risk, and what it's costing to work with your current advisor. Next, we'll identify your goals. Where do you see yourself in the next 5 years? Where do you want to go? And who do you hope to go there with? Is your current financial plan set up to get you there without mishap? Let's design a roadmap to create a financial plan you can follow with confidence. Get the piece that so many people are missing from their retirement. Find out how having a written plan can make a difference to your retirement dreams. Call now to schedule your complimentary, no-obligation, full-blown financial review today.
Welcome back to What Retirement Means to You with Jerry Means, and we're talking about how inflation can impact your retirement today. In fact, 1/3 of respondents in a poll from Qualtrics said they're convinced that they're going to need a larger nest egg before they're able to retire. Are you having to have those conversations with folks? I mean, maybe not your clients right now who are already retired, but what about folks who you've been talking to for the last few years who are thinking about retiring, maybe a year or two away? Are you having to start to pick up the phone and say, we might need to work another year or two? Is inflation that bad right now?
I think we have to proceed cautiously. Again, stress testing the portfolio, making sure that we're on track. That's why we call our process the on-track review, because it's exactly what we're looking to do. But I'm telling people, if you're not maxing out your 401k to the match, you probably should start doing that, right? Because a lot of people are contributing, but they're not taking full advantage of the match, and the match is free money. Now, above the match, I don't think they should continue to contribute to the 401k. Yes, they're going to lose that tax deduction, but taxes are on sale right now. They're the cheapest they're probably going to be. So why not go ahead, get the bigger paycheck, pay the taxes, then take that money and maybe invest it in a Roth IRA or a properly structured cash value life insurance that is averaging 4 to 5% a year in fixed rates, that they can pull out later tax-free, because 4 to 5% interest tax-free is just like earning 6-7% in a taxable bucket.
Okay, so I'm going to stop you right there, because you said a great the cash value life insurance. For me, in my head, I think of life insurance. Here's something I'm going to pay into that I'm never going to get anything out of. It's going to be for my family when I'm gone. What are you saying the cash value where I can start to pull out of it? Is this a different new kind of structure? Yeah,
so these type of plans aren't your grandfather's life insurance, right? This isn't for burial, right? Most of the people that I'm working with, they already have money set aside for that. They have enough investments that they can pay for their burial. That's not what we're talking about. We're talking about, one, you can use it for wealth replacement. If one of the spouses pass away, they're going to lose half of the Social Security income that comes into the house. They may lose a portion of the pension. That life insurance, lump sum tax-free, can help replace that. But also as living benefits, if you're overfunding the cash value, you can get that growing tax deferred. If you take it out properly structured, it comes out tax-free. They also can have long-term care benefits where they can accelerate the death benefit. So life insurance has really evolved and can be a great estate planning tool.
Wow. So when we're talking about these tax-free benefits, I can use that while I'm alive, if you're saying if it's funded in a certain way. Tell me a little bit more about the long-term care aspect of it, because I know there's a lot of folks out there who think that long-term care policies today are just too expensive on their own.
Yeah, so, and I would agree with that, honestly. When I first started in my career 23 years ago, I did a lot of long-term care insurance because I believed in it. I still believe in it. The problem is the pricing of it, right? So I would have people call me up and say, Jerry, I got a 30% rate increase on my long-term care insurance. I don't know if I can afford this. And that may happen to them 2 or 3 times before they need the benefits. So I like things that have a fixed premium, and life insurance has a fixed premium. So if it has an accelerated death benefit, basically you can't do 2 of 6 activities of daily living, right? You're having trouble eating on your own, transferring in and out of bed. Maybe you need a wheelchair or a walker to get around. Once you can't do 2 of those 6 things, it triggers the benefit and you can accelerate the death benefit. So if you have a $300,000 death benefit, you may be able to access 40% of that death benefit while you're living and do that tax-free.
Okay.
If it's properly structured. I always have to throw that in there.
If it's properly structured. Now, is this the kind of thing that folks out there can be kind of looking for on the internet themselves, or what kind of professional should they ask for to make sure they're getting advice that suits them best?
Well, unfortunately, if you go, into the internet world and you start shopping life insurance, they may show you the cheapest rates, right? I mean, they're looking just like car shopping, okay? If I buy $500,000 worth of life insurance, how much is going to cost me? What we're talking about is a lot different. We want to pay more for the life insurance so that only a portion of it's paying for the benefit, but you're overfunding it and you're leaving more money in the bucket to grow tax deferred. So it has to be structured right, and I think that really needs to be a conversation with a financial advisor or someone that's insurance licensed that can show you all the different options and how it works.
On today's program, we're talking about how inflation can affect you as a retiree. Obviously, we know it increases the cost of goods and services. When we say goods and services, we're talking food, gasoline, energy. But I think a lot of retirees think right before they go into retirement that their costs are going to go down. Let's maybe say that the mortgage is going to be paid off soon, so there's a big chunk right there. But there are a lot of other increasing costs that we have, such as our own medical costs, and I think other things that we might not think about, like roof repairs or replacing the car. We look at things like that today, and the cost of a used car is almost 40% higher than it was last year.
That's right.
Do you take into account things like inflation for those kind of, I don't know, I guess I would call it discretionary or emergency spending?
I do, and I think that's the difference of working with an advisor that's accumulation focused. You know, you're putting the money in the market, you've got plenty of time, markets go up, markets go down, but over the long haul, we know that we're going to do okay for the most part. With, you know, a preservation distribution specialist or someone that's focused in that area, we're looking at the whole picture for a retiree. And we like I said, we do portfolio testing. So I will sit down and say, okay, what is your Social Security? What is your pension? Let's look at your assets. Let's figure out what the gap is and how much income you're going to need. We have to do that budget to see what you need in retirement. I can't build a plan until I know what your plan is, right? What retirement means to you, right? So
Exactly.
what are you wanting to do? How much are you going to need? And then we have to fill that gap. But part of that gap, we have to look at, okay, well, what if inflation goes at 4% a year for a while? What if in 10 years you do need a new roof and you have to pull that money out? How is that going to affect your portfolio? That's all part of the stress testing that we do for our clients.
Okay, well, you do that for your clients, but from what I understand, you'll also do it for your viewers if they call in right now. So the stress test, they call into the phone number. What kind of information? First, are they going to come into the office, or is this something you can do over the phone? How does this work?
So what we do is we give the client an option. So if you're one of the first 10 callers and you give us a call, you can either set up a 15-minute phone call with me, or maybe I just answer some basic questions for you. Or you can come into the office or do a screen share, and we'll talk about your situation and what your concerns are. And then at that point, once I gather information from you, you feel comfortable, we set up a second meeting, and that's where I start doing the stress testing and showing solutions that we can offer you. And we do that at no cost, no obligation, and again, it's for the next 10 callers.
Thank you, Jerry. We'll take a very short break. When we come back, Market Watch says that nobody suffers more from higher inflation than retirees. The last time we saw inflation like this was in the 1970s, almost 50 years ago. So when we come back, solutions for you if you are retired. So first, the first 10 callers right now, call in and make sure that you get your stress test. It is complimentary. As Jerry said, you can either do a quick 15-minute phone call, go over some questions, or find out if you want to come into the office. Call the phone number you see right here, 844-878-1293. More What Retirement Means to You with Jerry Means right here in St. Louis when we get back right after this.
As a good saver, you've been putting away money during your working years. Studies find that the biggest fear of retirees is running out of money. Market volatility isn't just the downward movement of stock prices, it's the size and frequency of change. The more dramatic the ups and downs, the higher the volatility. This can put savers who are newly retired or a few years away from being retired at greater risk. Today's generation of retirees is not receiving traditional pensions as our parents or grandparents did. Instead, we have retirement accounts such as 401ks or 403bs. These accounts typically expose your money to market risk. The last thing you want right before retirement is to lose a portion of the money you need for income. But how do you turn these accounts into a retirement income? Is it safe to keep all your retirement money sitting in the stock market? The last thing you want is to lose a portion of the money you need for income due to market loss. By working with a financial professional, you can learn how to turn a portion of your savings into an income stream for life and income for the life of your spouse if you're married. We all have moments in our lives when we wish we had taken action sooner. Don't let procrastination reign on your retirement parade. Act now before it's too late. Please call our office to set up your no-cost, no-obligation retirement income review today.
Welcome back, St. Louis, to What Retirement Means to You with Jerry Means. I'm your host, Spike Spangle, and we've been talking about how inflation is affecting those who are preparing for retirement. Now I'd like to talk a little bit about those who are in retirement already. Okay. I mean, it's not like they can just decide, I'm going to go back and work longer or save a little bit more. they're kind of set with their nest egg and what they already have. Or I don't know, am I incorrect there? Are there solutions that people can look at right now for other ways to fight and battle against inflation?
Yeah, I think a lot of people have the misconception that retirement planning or financial planning is a one-time event. You go in, you get a plan, and you're done. It's not. It's an ongoing process because your life is constantly evolving. Politics are evolving, interest rates are evolving. So we have to keep up with that. We have to have conversations, see if anything has changed in your life and adapt the portfolio to that. And there's lots of things that you can do once you're already retired. Again, you want to get the best fixed income that you can, so you need to do some shopping around. We have tools to help you do that. If you look at bank rates, right? If you Google, what's a 5-year CD? I think today it's, the average is around 2%. Well, there's 5-year fixed annuities that are paying 4%. Well, that's double the interest rate, right? I mean, right there, that's a solution. It's not the end-all solution. It maybe is a part of the puzzle, but there's other things too. Like,
well, I want to stop you there because it's interesting. I understand what you're saying. So a bank CD rate will pay you 5% over the totality of it, but you're saying you get a fixed rate annuity right now at 4% annually, as opposed to over the 5 years.
Correct. I mean, the CD is paying 2% annually over a 5-year period.
Oh, yeah,
that's the average. Your lights on.
See, I know. See, this was the cool tool. I was afraid I was going to do that.
That's all right.
This is what you can get, folks, if you come into Jerry Means' office. But don't steal them by the handful right now. Yeah. This is a great tool.
And that's only for the next 10 callers.
That's only for the next for the next 10 callers. Get your complimentary pad from
limited
Jerry
supply. So.
Limited supply.
But yeah, of course. So the CDs are, on average, are paying 2%, per year over a 5-year period. You can get a fixed annuity right now paying 4% per year over a 5-year period. So that's double the interest.
Yeah.
And that's just one small solution, right? Or if you're sitting in cash because you're scared where the markets are at, there are alternatives out there. We were talking about cash value life insurance in the last segment. There's products out there that will allow you to put the money in there, and you can draw that cash value out even after a year if you want, and they link it to an index where you can get some of the upside, and it doesn't have a surrender charge on it, so it can be liquid. So it's a good lazy money replacement.
Right. Another study I saw was that men underestimate their own life expectancy, usually by at least 11 years, women by 15 or more. When you underestimate your own lifespan, what does that do to your life savings? What does that do to your nest egg?
Well, I can tell you I have a couple clients that are 100 years old.
Oh my gosh,
and if
wonderful.
You ask them, they'll tell you they didn't think they were going to live to be 100, right? And they're still active. That's the great thing about it. So people are living longer and longer. I don't think that's a secret anymore. And often I'll have someone come in and they'll say, yeah, Jerry, but that's not me because everyone in my family passes away before 70, And there is something to that as far as genetics and genes, but people are taking better care of themselves. There's been increases in health advances and medication. So you really have to plan for 20 or 30 years in retirement, and we hope that that's going to be a happy, successful, enjoyable retirement, but you have to plan for it.
Well, and the reason that I was asking you that is because when it comes to inflation, if we're just taking, let's say, the average of 2 or 3% that most people have done for the last 100 years, everything doubles in cost about every 20 years, give or take. But we are in a severe inflationary situation right now. What are you seeing for today's costs? Is this really eating away at people's nest eggs a lot quicker? There's something we've talked about before, the sequence of returns. People are getting really hit hard right now. How do we shelter ourselves from the storm?
So again, there's lots of vehicles out there that can limit your downside and sometimes limit it completely, or just they'll have a buffer, where maybe the first 20% of the market downturn, you don't realize that. It has to hit a 30% threshold before you have any of those losses. And there's things like buffer ETFs. So there's a lot of cool tools out there that are fairly new to the market. When I say fairly new, I mean maybe over the last 10, 15 years, which over the course of the market, those are new, right? That people aren't really aware of. They're sticking to that 60% stocks, 40% bonds, because it's what they've always heard works, and it does until it doesn't. And
well, you just made me curious, and I know people are out there listening to you as well. You said a buffer ETF. What exactly is that?
So an ETF is an exchange-traded fund. So it's a mutual fund. It's like a mutual fund that trades like a stock. So mutual funds are a basket of stocks, maybe 30 stocks. And you can buy a large cap growth mutual fund. And the thing is, you're spreading the risk across 30 different companies. Well, there's a lot of fees in that management of that. An ETF has a very low fee inside, administrative fee. And they're also more tax efficient in most cases.
Okay.
But basically, it's the same thing. It's a basket, but you can trade those intraday. So you can call up and trade those at 2 o'clock in the afternoon, where a mutual fund trades at the end of the day.
Right, and if I remember correctly, it's T+3. It's 3 trading days before that actually liquidates out. But the ETF on there, you can trade moment to moment,
just like a stock. Yep.
So you've gone through a whole variety of different. You've said we're talking about life insurance that has possibility for long-term care, for your own income riders within it, using ETFs. It sounds like your firm kind of takes a look at every single option that's out there. Am I correct?
It is. I mean, daily I'm looking into these things and trying to find solutions for my clients. So this is the time where you're going to find if your advisor is worth their weight in salt, right? I mean, you want to see in an up market, everyone looks like a genius, right? But in these type of times is when you really find out what kind of advice you've been getting. So, and again, to the next 10 callers, we're going to offer our complimentary on-track review. We'll sit down, we'll look at the fees that you're paying in your portfolio. We're going to look at the risk, see if you're taking too much risk or if there's alternatives that could help you accomplish your goal. We can look and see if you have a long-term care strategy and what it would look like if we implemented that into your plan. Basically, we would do a full stress test of your portfolio. And again, it's complimentary to the next 10 callers.
And then the next 10 after that, they get the free pen.
That's right.
But,
free pens for everyone today.
The free pens for everyone. Inflation is a big concern right now. It's great to know that there's someone like yourself who is out there paying attention to that and different solutions. And another thing I just wanted to say before we wrap up, the solutions for you out there might be completely different from every single different person, right? It's not the same solution for every family.
That is correct. I mean, we're not here offering cookie cutter solutions. Everyone's life is different, and that's why that first meeting is so important, because I want to get to know the client and understand what they're looking to do, what retirement means to them. And once we figure that out and we can look at what it costs to live that lifestyle, then we can look at the investments and figure out, okay, how can we design that plan, and then let's stress test what ifs.
Jerry, thank you so much for everything today. We're going to be back again next week. I'm going to tell the folks about your complimentary review. Folks, if you want to take a look at your taxes, your investments, how much risk are you taking? Do you have a legacy plan in place? All you got to do is call the phone number right here. It is totally complimentary. 844-878-1293. Thank you so much for watching What Retirement Means to You with Jerry Means. I'm your host, Spike Spangle. We'll be back again next week.